Robert Crayford at the end, New City Investment Fund Managers, which is part of the CQS hedge fund group, if I can call it that. Gervais Williams, who's now at Miton these days, many years ago in this building, I think, at Gartmore, as I remember. Amanda Van Dyke, who runs, what's your fund called, Amanda? Peterhouse Asset Management, that's the one. And David Manuel, of course, of Beagle Partners. So we're here to talk about how we find value in small cap miners in the current climate. And I think the best way to open that up is to just throw that over to Robert Crayford at the end. How do you do it, Robert?
Thanks, Tree Hospital Pass. Is this on? Is that working?
Yep.
So, I mean, given the topic for this, small cap mining, we definitely find a lot of value currently in small cap miners, and there's been a couple of major drivers to that. So that firstly comes from the institutional fund managers who've been heavily focusing on liquidity. And there's also come from the retail investors who've been focusing more on investing in ETFs, and we've seen a big increase in value for ETFs, and that's also been focusing on liquidity. So as a result, we've seen a massive valuation divergence between those larger cap and smaller cap stocks, and the GDXJ would be a prime example for that. So that is the junior gold mining ETF. So we're actually seeing a divergence of somewhere in the region of about 0.7 price to NAV for the smaller cap producers versus about 1.2 to 1.5 for the larger cap. Can I keep going?
Yeah, keep going.
So, I mean, the reality of that is that, yes, we are continuing to see ETF flows, but in the case of the GDXJ, back in June, we saw that outgrew its underlying sector. As a result, they had to sell down a lot of their smaller cap stocks and actually buy some larger cap stocks. So we now have a small cap index that has companies in there with market cap around 3.5 billion. So I don't believe that is necessarily fit for purpose. What we have now is smaller cap companies that are cheaper, with better cash flow, strong assets, and we believe that they should benefit from a future M&A cycle because the larger cap companies have underinvested in exploration capex for the last 5 years.
Okay, we'll probably get back onto the M&A side of things. Gervais, you've been investing in small cap stocks for a long time now, so you must be pretty expert at it, I guess.
Yeah, I've had some winners, I've had some losers, needless to say. I think the whole point about smaller companies, particularly smaller mining companies, is that they have so much more upside. When you get them right, a small amount of incremental resource actually makes a big difference to share prices. I think what's interesting about the current sector is that markets themselves have been very good this year. We've had world growth, which has been pretty strong. A lot of people think perhaps that the risks on the downside have passed. I don't think so. I'm still quite cautious about the long-term outlook for the world economy. I think we're in structural stagnation. And most particularly, there's room for disappointment along the way, perhaps because of a political event or possibly an economic event. Either way, the opportunity of investing in assets which are non-correlated, and many of the mining companies, particularly in the gold and some of the precious sides of things, are particularly uncorrelated with markets, is very attractive. And with a certain amount of scar tissue out there over the last 3 years, particularly in the oil sector, small oils have come down a long way. I think there's a disproportionate upside, and if anything, I think the inclination for institutions to start writing checks in this area is actually increasing at the moment, and that would be a big effect because extra cash in a company which is perhaps underpowered at the moment, which could then get financed to get through to production and grow its volumes from there, can get a disproportionate return. So we're pretty upbeat about the sector at the moment.
So I guess from your days at Gartmore, you know how the bigger institutions react to the environment and when they start to turn on the liquidity for these things.
Yes, I mean the truth is that a lot of investors price to recent experience, and recent experience has been that certain companies, particularly at the smaller end, haven't done so well because the sectors have come down. Perhaps some of the projects haven't succeeded in every case, but because of that, I think valuations are really actually disproportionately low at the moment, which is very uncomfortable for many of you out there at the moment. But on the other hand, it means that actually getting together with an institution and writing a few checks can make disproportionate return.
They sure can. Amanda, how would you follow that?
I would completely agree that there's a huge amount of value in the junior mining space right now. Junior gold mining specifically has really diverged from the gold price in terms of how junior gold mining equities are doing, and I think that some excitement in the gold space would likely re-rate it all by itself, but we might be a few months away from that. It's a stock picking environment for really good value stocks in the junior space right now. It's a lot more fun to play some of the battery metals in junior mining because they have reacted, and they are responding a bit more to the market in a more general way than perhaps the gold ones are.
What do you reckon, David? Where's the value, and how are we going to realise it?
Good question. There are pockets of value, if you like. So you find value where markets are overlooking those stocks. So it tends to be away from, Amanda mentioned, the battery metals, and that's kind of where you want what you're investing in to be in 12 months' time. So when you're looking for an exit, you want excitement and interest in the area and people wanting to put money into it. When you're looking for value, you're looking for places that have been overlooked where there's the potential for something to change. Now that you can get value by looking for things that are in production that have just been overlooked, so they're actually generating cash flow, interesting cash yields, and you'll get paid back at least with dividends, and maybe somebody will pick the stock up. Or you can find value in assets that have been overlooked, that have failed during the difficult times to get funding, to then, as Gervais was saying, institutions discover the stock, decide they'll fund the next stage of development, and then interest is rekindled. But as John was saying, the key thing with finding value is actually seeing a pathway to the realization of that value for other people to get excited and get involved. Otherwise, the value will sit there, and particularly with junior miners where there's no cash generation, it'll even go to the point where it erodes. If they can't develop their asset, they just burn a little bit of cash each year and don't go anywhere.
And David, you mentioned to me outside about the psychology of the market. You're trying to forecast where the next interesting area is going to be, when the excitement comes from. How do you figure that one out?
Gosh, well, the psychology is not easy, but my comment about psychology earlier when I was talking to John was really coming from what's going on in the battery metals side. So it's where the market gets excited about something, it gets interested in it, but you don't really know what the end game is. You don't know what the end market is going to be pricing the material at. So whether that's lithium, how big's the market going to be? How big's the supply going to be? Lots and lots of unknowns. So the outcome could be almost anything. So people then tend to gauge their interest by seeing what other investors are doing. And you can get the psychology, momentum of people hear the buzz about the sector and decide, yes, well, let's invest because everyone else seems to be talking about it. And then you'll get a stage where people who you would regard as authorities start saying, yes, that's interesting. And so you get mining funds, people like us talking about the stocks. And if you were going to make the analogy of cryptocurrencies, you get some of the institutions talking about investing in cryptocurrencies. All those kind of things tend to make investors generally a bit more confident, and they keep on buying. And once the stock's gone up hugely, they'll then stop and pause and think about it, and then you get a final phase where they feel that they have to be in because otherwise they're going to miss out. And then you reach a peak and the bubble bursts and it starts to come down.
So does anyone feel there's a connection somehow between cryptocurrencies and what goes on in the gold market?
I'm happy to have a chat on that. I mean, the interesting thing about cryptocurrencies is that currently, this month, cryptocurrencies are consuming 0.16% of the total energy generated by the world, electricity generated by the world. And if it carries on in its current projection, it's going up pretty hard at the moment this month because the currency has been pretty strong, that will be consuming 3% of the entire world energy, world electricity. So it's something to look forward to, probably unsustainable, let's be honest. But it just shows how much momentum can play a part in this. And unfortunately, a lot of investors do feel a bit embarrassed when they're not performing well. We've seen that with the FANGs this year. A lot of investors haven't had enough FANGs. We've seen it probably in the largest end of the AIM market, where some of the valuations on some of the very large AIM stocks have done extremely well. And these are good companies, don't get me wrong. I'm not criticizing the companies, but I just think the valuations are often driven by momentum. And momentum is just alive and well. at the very extremes of the market, which means that actually a change in trend, and I think a change in trend will come in due course, whether it's months or years, I don't know, but I think there will be a change in trend, and at that stage, assets which are less correlated with this momentum are going to be disproportionately valuable. And that's where I come back to some gold, silver, and those kinds of companies, where I think investors should be absolutely taking a decent proportion of their assets in those companies right now for that outcome.
Robert, what do you think?
I would certainly second that. Yeah, I think you want to be looking for real stores of value. I mean, I'm 100% behind blockchain. I think that 100% makes sense, and I think that is going to change the world as we see it today. I can only look at Bitcoin and ever think that it looks and fits exactly the description of a Ponzi scheme, and I worry slightly that it could continue to gain momentum from here because it's primarily being led by retail, and it does actually concern me. I mean, even if we looked at it as a currency, I don't think it would even be the most sensible currency because you already have Ethereum, which is already a shorter blockchain and would make more sense. I mean, if we look to sort of the Googles and AskGs, I think it's very much a very early iteration of what an answer might be, even if we do believe that cryptocurrencies play out. I don't think it is the most sensible method for making payments, for example.
I could just follow on to that. I think that cryptocurrencies are popular right now because people are looking for stores of value that aren't a really inflated FANG asset class or economies that are frankly looking very, very bubbly. And cryptocurrencies are an alternative to that. And that alternative used to be gold and silver. But after a very long bear market and a bit of a blip up, the reality is in gold and silver, people have gone very heavily into ETFs because they've been hurt investing in the mining space in the past. And cryptocurrencies are a hotter way to get that sense of value in the market. But eventually, cryptocurrencies are a very unknown entity and are likely to at least crash down to a reasonable size from the bubble and momentum that they're playing in now. And in that market, especially when if asset classes do correct as people think they will, there will be a lot of money flowing back into gold and silver stocks, as mentioned. And if you got in the right value plays, you should be able to see a re-rating of them that comes with a correction in the very bubbly asset classes that are out there right now.
So which commodity should we be buying for when this cryptocurrency bubble bursts?
For the cryptocurrency bubble itself, you probably want to be in gold and silver.
I was going to say, you can look at platinum, you can look at some of the palladium, those kind of areas. Other precious metals, possibly rare earths, one or two of those areas as well. But you want somewhere which is a store of value, as you say. And the store of value issue is that most people have come to think that all sorts of things are stores of value, ETFs, currencies, and all the rest of it. But I think at the end of the day, we've seen fiat money being created in very large size, and that really undermines long-term the ability of money in its normal sense to act as a store of value. And for that reason, you're going to need to go for physical assets. And gold and silver are very good physical assets. And there are other physical assets which are generating consistent cash, might be businesses which are very insensitive to the economy. They might be interesting areas for stores of value as well.
So how do you see the smaller mining stocks fitting in with this? Maybe David.
I think where the smaller mining stocks actually generate cash, they fit in with that. I mean, the Bitcoin isn't going to generate any cash for you. It's only going to generate returns whilst the Bitcoin are going up. So I think where you have real assets which produce real cash, that's where you've got a backstop to your investing.
And what do you think of the idea of buying companies that have projects but aren't yet, but are still a year or two or three away from production?
I think there are definitely opportunities there. I mean, where the project makes sense and where you can see it being funded. So one of the important things we look at when we're looking at a pre-production asset and where it's going to need to raise a substantial amount of money, so building the mine costs a multiple of the current market cap, you've got to look at the kind of investors that are already involved. Can they back the company? You've got to look at the kind of relationships they've got with suppliers, with customers. So can they get funding or bankability of their product? We may prove a problem with some of the battery metal companies as they need to raise a large amount of money to build a mine. There's a lot of uncertainty what the actual price of the commodity will be, so it'll be difficult to get bank funding for them. So it's really looking at the credibility of the product and the project. Once you can see a pathway to them getting into production and cash flow, then that's the last stage, and that should unlock an awful lot of value.
Now, the funding issue is interesting because there seem to be less banks funding, but there are all these commodity traders now funding, and streaming agreements, royalty agreements, all sorts of other sources of cash that are suddenly available to the market. And I think it's changing the picture. So I wonder what views you guys have got on that.
There's a lot of different sources of cash, but a certain amount of equity is always required to fund any project. Like, no bank will ever fund unless you have, I would say, usually a minimum of 25% provided by equity. One of the sort of rules of thumb that I keep in the sort of back of my mind all the time is, no matter how hot the commodity is, how well the company's doing, unless they're in the bottom half of the cost curve, their resistance to changes in the market and changes in sentiment won't be there. And this, if you've got royalties and streaming and forward cash payments and all of that sort of thing, most of them mean in the long term not any money left for shareholders, or the shareholders are going to get paid 5 or 10 years down. And everyone likes a long-term investor, but I'm not looking to wait 5 or 10 years before I get a return on my investment. I would like to see a return on my investment in a much shorter time frame. So you need to be careful. If you do everything through financing, it's just not attractive to equity because we'll never get paid back. And we'll never see a return on our equity investment. And on top of that, if you don't have some really stable margins to support that, equity is not going to be interested in all. And no matter how many other forms of financing there are out there, you will always need some equity. And because of the ETFs in the market right now, there's far less active new money going into projects and equity around. So we can afford to be a lot pickier with what we invest in as well.
Yeah, I mean, I would add to that. I don't think there's any restriction in capital from either equity or the banks. A number of the major lending banks are very willing to lend on quality projects, and there's a real difference. And to Amanda's point, it's very much in that kind of bottom quartile, or at least bottom half of the cost curve.
Yeah, I mean, I push on and say really the big difference for investors is whether it's been the last fundraising or not. The last fundraising is the big issue. If you don't have any further fundraisings after that, if you've got enough cash, particularly if you've got surplus capital, it means that you can take a bit of risk on and delays and still hit the finishing post. That is a big event. So I think we are prepared to wait 2 or 3 years in our case, but we like to feel we've had the last fundraising, and that makes all the difference to us.
Sadly, as we know, with junior mining stocks, it's often not the last fundraising. And from my perspective, what we're now seeing is the stocks are rising up to a level where the smaller of what I call the household institutions are beginning to take an interest in these things. So we now see Amati, M&G, BlackRock coming into some of these stocks, which we haven't seen for a few years. So I wonder what you guys are seeing. You know, is this built into your strategy? Are you happy to see these guys coming in and supporting these stocks, or do you feel that maybe they're just sort of dipping a toe in the water and maybe they're not really there?
One thing I might say is I'm not as pushy about mergers and takeovers. I don't necessarily see that being as the way forward. I mean, a good project with a good management team, with a cash payback, which is attractive, is just fine for me. And whether it's a sort of 20 or 30 million market cap at entry or a 200 or 300 million market cap at entry actually is less relevant. In fact, you might argue that the very small company might actually have much more upside as it discovers more ounces, and it doesn't need a lot more ounces in many cases to make a very big upside on the equity. So I'm certainly not anything like as enthusiastic as others for mergers at the moment.
I would actually follow on. One of my least favorite things when a broker calls me is it's a massive takeout candidate. I invest, and I think most of us invest on fundamentals, on the ability to make return on the equity I've got, not to let the takeout guy take my upside, if that makes any sense.
David, any thoughts?
Well, if you're relying on somebody to take out the asset to buy you out of it, you're taking a huge risk, really, because if for some reason when you get to the stage of you thought you were going to be taken out, there are no buyers, you're in a very difficult situation and probably trapped in an illiquid asset. So that's a very tricky place to be. Money will become available as the bigger guys generate cash and start looking around to replenish their resources. But I think, as Gervais was saying, that if you've got a project that's going to generate cash and pay you dividends, then you should be quite happy with investing on that basis. Companies that are built for a takeover often come quite unstuck if that takeover doesn't take place.
We see this whole drive towards electric vehicles and sort of change in the way our economies are working as quite significant. And the whole raft of trading companies have come into the market. So you've got Noble Group backing Macango as a rare earths company. You've got Thiess backing Rainbow, again another rare earths business, but also others within other commodity spaces. And these guys are backing companies. They want to back it all the way through to production, come what may. They care less about the valuation and more about getting to the end point. Do you see this as something that you guys can support?
Yeah, I mean, ultimately, yeah, if you have that backing, I mean, we see the likes of VW have been out sort of 2 or 3 times now trying to buy a reasonable volume of cobalt, and they just haven't been able to strike a fixed contract price. So clearly there is tightness, and I think an end outcome is going to be that they will be, potentially, anyway, potential outcomes that they could end up looking to fund directly into a mine or something like that as far as an expansion to secure that supply. But, I mean, I would voice a sort of word of caution, and I know there's a real divergent view across battery metals, but something we're very conscious of is that technology is changing very rapidly. And even with lithium, for example, we're seeing solid-state batteries now being talked about more and more. Dyson and Toyota and Dyson are now talking about introducing them or bringing them into commercial production by 2022. And some people have been designing solid-state batteries are talking about actually substituting lithium in the entirety. So when we look at these new battery metals, we try and apply a lower multiple with a greater focus on sort of nearer-term free cash flow, because we do not know necessarily what's going to happen to the technology in 5 to 10 years.
I think I would echo that you need to be quite careful when you're investing in anything that's tech-based, because tech changes constantly. One of the things, we were talking about cryptocurrencies and what's popular. EV and anything electric vehicle-based is very exciting right now, but it is all based on tech, just like cryptocurrencies are based on tech. And cryptocurrencies are also based on currencies, which traditionally have been the least callable, one of the least callable asset classes, if you can call it that, and the most volatile in history. So if you take tech and cross it with global foreign currencies, you're talking about an extremely volatile market that you need to be quite careful on.
I mean, I've definitely pushed that. I mean, I'm exactly on the same page as Amanda and Robert on this. I mean, in fact, if anything, what I note, is when you look back at technologies, you see how they don't last long. So if we were sitting here, 5 or 10 years ago, BlackBerry was a big company. Now it's no longer there. Nokia, you could say the same. Apple happens to be the biggest company in the world, and maybe it'll stay the biggest company in the world. But who's to say? Easy come, easy go. So from that point of view, you don't need to overlay extra risk in the mining sector. We don't have anything at all to do any of these mining companies.
And if I can just hit you in the last few minutes, do you want to give us your best thoughts, best ideas on junior stocks or the commodities to back?
Yeah, well, I'll start from this end. Yeah, I mean, my favourite metal at the moment is zinc. It's not necessarily, I'm not on my own with that. A lot of people have also been talking to zinc. We actually believe that there's at least a 3 to 4 year period of mining companies being able to mine zinc at somewhere around these prices. The reason I'm so constructive on it is actually on an equity perspective, is I don't think the equities are implying that. So you can look to the largest pure play, which would be Trevali. That is currently generating somewhere around a sort of 20% plus free cash flow yield. We believe they've got at least 3 to 4 years. There's some smaller names that we're also invested in, names like Ascendant Resources, which is a company that bought a mine off Nyastar for only $500,000. we've recapitalised that. That also looks very interesting on a cash flow, free cash flow, well, cash flow point at the moment because they're still having to reinvest in the mine. But yeah, ultimately, I mean, we've seen reserves come down to around 9 days of global supply now. There are some new mines, some brownfields starting back up, which will come in around sort of 1 year to 2 years' time. But we don't believe there's enough volume there to offset that increasing demand that we're seeing out of China.
Gervais?
Yeah, and it's not surprisingly, gold and silver I'm very keen on at the moment. I think what's interesting is how things can change so quickly. So if you take Caledonia Mining, which is a gold miner in Zimbabwe, you can see how much things can change just in a week or two. So here's a company which was on a P of 4 and a yield of 8, operating in a fairly difficult environment, but with actually improving situation behind it. And those are the kind of areas where you can make a disproportionate return.
Amanda?
I agree. I think the best value in the junior mining market right now I see in gold and silver, just because they're so unloved on the equity level, and you can pick there's some really good picks, but I do think that a bit more patience. I think we've got at least another 3 to 6 months before the junior gold equities start to catch a bid, hopefully. I like zinc. I actually think copper, if I really wanted to play EV, I'm not as against lithium, but I think that copper is probably the one thing that you know is going to be in the new batteries, no matter what. There's more copper in an electric vehicle than just about any other metal. Copper has probably got another couple years till it has a really good run, but if you could get yourself placed in some decent bottom quartile copper plays, I think that would be a really good place to be.
David, you get the last word.
Well, our second copper, so copper and nickel, in part because they're traditional base metals, and I think we are in a global recovery mode. So we've got a few years of reasonable general demand growth, which has always traditionally supported those two metals. But they also do plug into the EV trend. So nickel going into batteries, but copper not just in terms of the batteries and the motors, but also if you're going to recharge your car, you need to get power to it, which means you need a copper cable. And if you're going to recharge a Tesla in 6 minutes or something like that, you need a very big copper cable. So there's a lot of demand going to be for copper in terms of the electricity infrastructure, as well as actually sort of within vehicles or within devices using electricity.
Well, thank you to the panel for your insights. Thank you to you as an audience for listening. Thank you to the one-to-one guys for organising the event. And thank you to Blytheway for the drinks that we're about to have.